Hello everyone, welcome to the channel. This is Fair Value Finder, and today, since it's Friday and options are expiring, I wanted to do a quick video on hedging your bets and your positions. This is something that I've mentioned a few times throughout my videos, and this gives me the chance to show you guys exactly what I'm talking about. So I had recently analyzed AbbVie, and I did not believe that it was worth the value that it was trading at. It was reasonable value, but I didn't see a whole lot of upside, especially after those earnings. So I opened a call credit spread. So for this, I bought a 167.5 call and I sold a 165 call. So this is me saying I don't think the share price is going to go above $165. So I'm making an agreement with one person where I say, I don't think it's going above $165, but you do. So I will sell you 100 shares of the stock for $165 a piece if it does go above that price by May 5th. But I don't have 100 shares of the stock to be able to give them. So that's where I open the other leg and I turn to someone else and I say, hey, I think that the share price is going to go above 167.5, and they make the same bet that I just did on the other side. So I'm telling one person, hey, I'll sell you shares for 165, and another person, hey, I'll buy shares from you for 167.5. And you might be thinking, okay, that's a $200 loss, but I get paid the premium here. So I got paid $66 to be a middleman here. And if it were to close today between 165 and 167.5, I'd be out up to $250. I mean, I could potentially still exit my position, but my max risk was $250 if the share price were to get up. Let's say if it got up to 167.5 or above, I would be out $250. Or would I? Because I collected a credit of $66. So that would give us a total loss of $184. Max gain is $66. I'm going to hit my max gain. The market closes in a little over an hour and the share price is currently at 148. So I keep that $66 to myself. And you might be thinking, your max gain is 66, your max loss is 184. Where does this benefit you? Like, there's way more downside than there is upside. That's where probability of profit. I mean, the more risk that I'm willing to take, the more money I could collect. I could have opened a bet that was in the money. I don't remember what the share price was at the time which I opened this, but I could have collected over $100 and taken a much riskier bet for the same $250 loss. I talk pretty often about covered calls. This is a case for covered call. I do own, as I mentioned in my Key Corp video, 200 shares of Key. And so I wanted to hedge my downside, which was a very good idea. I sold 2 covered calls at $12.50, and I was paid $28 for a break-even price of $12.78. Worst case scenario would be Key skyrocketing up to the moon, and I would be able to sell my shares for essentially $12.78 a piece. Clearly it didn't, and I ended up collecting my money, so I am up $54 on this position. It closes later today, so between this and the other position, I'm making $120 today. There's a third hedge closing this week. So stocks like Coca-Cola and AbbVie I don't own 100 shares of. I don't see myself owning 100 shares of either of them for a little while. But I can still hedge my bets with as little as $50. This one is a 100. AbbVie was $250, but there are some stocks where you're able to do it for as little as 50. The spread is 50 cents on the option strikes. So you see here, I'm making $14. This is the same story as the AbbVie that we looked at. You can see that I was betting that it would stay below $65. It's closing out today, looking very close to $64. 64.07. The point here is there's more ways to make money off of your stocks than just capital gains. I don't need the stock to I don't need to buy the stock at 60 and let it run up to 65 to make a $5 profit. I could hold it and collect dividends, or I could open a put credit spread if I do think it's going to go up and collect $5 that way. I mean, it would take an extra $50 of capital, but typically when I'm doing something like that, I think the stock's going to go up. I open a put credit spread. I take the premium, put it directly into the stock that I open the option on, and I let it ride out. So I am building my equity and doubling down on my bet that the stock's going to be going up. And I could be even safer with it, and I could have an upside hedge and say, I don't think it's going to go past this point. And so if it ends up going down, I make money there too. Or if it doesn't go up enough, I make money. And this is a strategy that I learned about a year ago. Usually it's referred to as a theta gang strategy because you are profiting off the theta of the option, the time value that is associated with it. And on an average month, I make $300 to $400. More recently, I've gotten more serious about it, done more research, made more trades, especially with cash in my account. It's a whole lot easier to do. And I recently made over $1,000 in a month on my trades and hedges. So this is one of the main drivers that helps me bring capital into my portfolio that I can then invest into dividend and value stocks to grow it through two other means. And I can make these plays on those dividend and value stocks. So that way, if the stock were to tank, I wouldn't lose as much money. And if you were to look at it as a long-term investment and you don't plan on selling out, then it's just a gain for you, and it allows you to buy more and continue riding out the wave.